I have the pleasure of introducing our very first presenter, Sean Kevelighan. And Sean is the President and Chief Executive Officer at the Insurance Institute, or Insurance Information Institute, so triple I. He was named CEO and President in August 2016, and Sean comes with a really good, impressive background. He was Group Head of Public Affairs for Zurich Insurance Group. He worked for Citigroup as Head of Strategic Communications. He worked in the public sector. He worked as a political appointee in the President Bush administration as a senior advisor on the tax policy. He was a press secretary for the White House Office of Management and Budget. He worked in the private sector, and he worked for a public affairs firm, prestigious Edelman and Hill in Knowlton. Sean is a graduate of the University of Colorado at Boulder. He and his wife, Annick, have 3 children. He is an avid enthusiast of exercise and outdoors, and participating regularly in triathlons and other sporting events. So if you can please help me welcome Sean Kevelighan.
Thank you. Thanks a lot. Appreciate it. I think I've got to take that last sentence off my bio now that I've got 3 kids under 7. I'm trying to remember the last time I did a triathlon. This one. All right, I'm going to set up here. Which made for an interesting COVID, too, finding a quiet spot in a little row house in Georgetown with 3 children, 7 and under. I'll talk to you a little bit about some of the stuff that we went through during COVID as an industry. The Insurance Information Institute, if you're not familiar with us, we're a mission-driven organization. We're a nonprofit. We're 60 years old. We were founded by the carriers of the industry. It's really unique and I'll point out a lot of these types of organizations like ours in the insurance industry where we are trying to be mission-driven and trying to provide a societal good. So we try to provide data-driven insights on insurance. We seek to inform and empower consumers in our industry to better understand insurance and risk management. We're all about empowerment. What we also seek is a world of more insurance. Bringing insurance into an industry, we'll talk a little bit about some of the data that we've done. We've been able to prove at III that more insured communities recover faster. So we do aim to close that protection gap that we're all pretty familiar with. One of the things we talk about a lot is this disruption continuum. Disruption's been a bit of a buzzword of late, but this is actually what insurance does, right? We look at what's happening in society and how to manage that risk. 2 years ago, there were 4 boxes on this screen. We've had to add, of course, you've got natural catastrophes. You've got the economic volatility, political risk, technology, the 4th industrial revolution, the combination of cyber and human coming together. And then the last 2 years, we're experiencing COVID, and we're also experiencing a significant amount of civil unrest, especially in our country. So we have a bigger disruption continuum, but I would argue this industry has been around for 300 years for a reason, because we know disruption, we know how to manage risk. And I think coming out of COVID, we'll be looking at different ways that we did, in fact, manage and led through this disruptive phase. It's interesting in insurance as well, as I think we manage and measure success a little differently as an industry. We recover economies. We are financial first responders. As soon as the government gets in and saves and the floodwaters go away, we are there recovering the economy. We seek to have better community well-being. Our organization was set up, again, to inform consumers about insurance. If you look at some of the other organizations that we have, the IIHS, again, insurance-backed organization, what they've done for traffic safety. Arguably, every auto manufacturer shakes in their boots when they find out IIHS is testing one of their vehicles. So we do a lot for community well-being. We protect capital. I'll talk a little bit about how we protect that capital and keep it on hand and how we withstand your traditional economic ups and downs that happen. Resilience is a big thing, especially as the changes that we're seeing right now with climate. I know Steve, our next speaker, is going to talk even more about the changes we're seeing with climate and what's happening. And then as well as an industry, we're really coming together on fairness and equality, and how do we have an industry where our talent reflects the communities where we work and serve. How do we make sure that we're informing people about what fairness means in terms of pricing? These are big issues that we're trying to pay attention to and make sure people understand what insurance is doing for all of them. So going in and reflecting on COVID and what happened in the industry, it's a nice story to tell. This industry really stepped up. Charitable giving was up, nearly $300 million in charitable giving that we gave to the communities. We stepped up and gave auto insurance premiums back. Nearly over $14 billion in auto insurance premiums were returned to consumers. We were hiring people through COVID-19 and still are. Every sector of the industry, property casualty, agents and brokers, life, health, all of those in insurance were hiring and are still hiring and even committed to keep people hired. And then finally, what we did as an industry is we stepped up in our innovation. Right? As people were working at home, as all of this was happening, did not mean that catastrophes stopped as well. And so we were able to remotely ensure and keep our promises as an industry all throughout that disruption of COVID. One of the things, though, at IIII that came very, very pronounced is we needed to explain why a pandemic is largely an uninsurable event. So if you look at 9/11, 9/11 was felt by everyone in this country and around the world, but primarily two economies were impacted, New York City and Washington, D.C. So not even the entire state of New York, but primarily from an economic standpoint. But when you look at what happened in the pandemic, you've got nearly every economy in this country and around the world that is impacted at the same time. So that law of large numbers that our industry bases itself on is impossible. You just simply can't underwrite this risk. That wasn't what the trial attorneys wanted to believe, or at least our customers, right? And one of the things that we say is, well, who could have predicted this pandemic? Insurance actually predicted it, because the policies that we write had many exclusions. So beyond also, the fact that a business insurance policy needs physical damage, which a virus doesn't project, we also clarified it through exclusions in our policies. Nonetheless, we had trial attorneys that were convincing customers that they should file legal claims. And so you're seeing here a spike in the filings of legal claims, in particular in the food industry. We had celebrity chefs out there meeting with our president, telling him that the claims needed to be paid. Lots and lots of news going on about this. Lots of potential danger for our industry. In fact, they were able to also convince legislators that we should start thinking about retroactively writing contracts, which in our own economic analysis at IIII proved you would have bankrupted this industry in a matter of months if you did business insurance policies broadly, or if you just did business interruption. So we had some actual concern on our hands, and one thing we did at IIII was we set up a campaign, The Future of American Insurance and Reinsurance, and you can go there now. It's fairinsure.org. And we had to aggressively inform this discussion. We had to make people understand what was going to happen if you retroactively fit contracts. That claims that you all are setting aside to pay for natural catastrophes and other things that are insurable were in danger. So we worked very hard to do this. We used digital advertising. We testified before Congress. And one thing that we've done now, if you still go to the website, you can actually get more informed on the likes what we heard earlier, risk-based pricing, ESG, and innovation. All of these things are now challenges that we need to inform discussions on. A year ago, we were at the peak of this campaign. This is just media coverage that was happening. Because you had celebrity chefs, because you had the sporting world, you had a lot of attention being paid to this, a lot of familiar names happening, and a lot of media coverage. Now what you're gladly seeing is by the end of the year, the discussion is going down and it's gone into litigation phase, which is still going to be costly to this industry because we've got runaway litigation happening. Nonetheless, we do feel we were able to inform this discussion in the right way and make sure that people understood, and they took the retroactive contract issue right off the shelf, which was a very good thing. So now, and just last week, there was a hearing on this, The whole reason why everybody was up in arms is because there was no system in place to make sure that we systematically were able to address a pandemic at a government level, because the federal government is the only entity that has the financial wherewithal to help and provide that financial relief. We still don't have a system. And that's why as we went through all of this and all of the media and the hoopla that was happening is because the government didn't have a system, and when you don't have a system and government set up, politics set in, and so we began to see delays in all of the financial relief that they needed. Again, our customers wanted help, so they were trying to get help any way possible they could. Now they're talking about it. They had a hearing, like I said, about a federal system. What we're doing at III is making sure that people understand we need the federal government to take a primary role in this. You know, this is not an insurable event. It's got to be widely accessible and efficient, and try and eliminate fraud. And then finally, it needs to address and understand business industries like insurance, and not make sure that we're trying to fit something into an industry that's not capable of handling it all. There's still discussion and debate as to whether or not insurance should have a role in the facilitation of the system or not. And that was the arguments that were made last week before Congress. I don't think we'll actually get anywhere with this system. I think it's going to go off the shelf. They've got other things on. So at this point, I think we're just having hearings because we need to have hearings, and God forbid a pandemic happen again, but we don't have a system in place yet. And so I do think we're potentially at risk again in our industry if something happens and we don't have a system in place at the government level. So how did the industry fare economically? And our senior economist, I'm not an economist, I just play one on this stage with you because the senior economist it helps me out. But he's he wants to make sure that we call it insurance economics, because insurance economics is different. And this is one thing that we've struggled with sometimes as an industry, is making people understand we are different in financial services, and people need to understand that. In fact, we've been doing a lot of that work and briefing the likes of the Federal Reserve to help them understand the difference of insurance, because during the first financial crisis, when I came into this industry, we were chasing a news cycle and a potential risk in our industry because we got lumped in with banks, because people didn't understand that insurance is largely, because the way we model ourselves, because we hold capital for long term, we don't have those short-term blips that we saw in the likes of banking. So we've got to educate people, and we've got to make people understand that insurance economics are different. The economy and insurance are very strongly tied to one another. As you can see here, this is net premium growth, or I'm sorry, direct written premiums with year-over-year GDP. Thankfully, we lagged just a little bit, so that big orange dip that you're seeing in our economy, we didn't have as much of that, but it was a negative environment for us overall. Keep hitting the wrong button, sorry. So where are we going now? This is a big debate. It's actually historically unprecedented where the spectrum of opinions are as to where the economy is going. You've got a market side that's looking at a short-term picture, and you've got the Fed side that looks at a long-term picture. Monetary policy is always a longer-term. We think at the III that you need to understand it's a 2-year view, not a year view. So we don't want to, most of the stuff that we'll start looking at, we don't look at year over year in this case. We look at 2 years. Because if you look at year over year, it's just not a comparison. It's absolutely apples and oranges in terms of how you look at that. We're just getting back to normal. So to look at year over year versus the economic chaos that happened in 2020 isn't, in our opinion, an accurate way to look at how we're going to recover. So we look at that kind of VU recovery that extends into 2022. The Fed is talking about employment. This is a big thing for them in terms of where they're going with their rates and where they think the economic growth will happen. And we do have an unemployment issue. We do have a labor issue. We have labor shortage. People are not going back to work. People left big urban centers like New York City, and they haven't come back yet. So we've got an issue with employment that's still out there, and again, it's not a year over year. It's going to take a couple years to get this employment levels back to where they were, and that's where the Fed is looking at. Whereas the market thinks this is all about inflation. And again, if you look at inflation simply from a year over year, it's an apples to oranges comparison. Because again, we're getting back to normal. We had significant changes that were happening that just aren't economically sustainable, and so it's a different view. It's a short-term view, which markets tend to do, but that's where the big difference in the spectrum of where the economy is going. The market believes it's going to jump right back up. The Fed thinks this is going to be a little bit slower. We tend to agree with the Fed, and we tend to, even on inflation and pricing, you're going to see some inflation, but the trends are going to go much slower, and it will get back into a normal place. We believe this is a short-term inflation issue, not a long-term inflation issue. And this is because it's a bit of a transition. You're seeing pockets have more inflation, pockets in our economy in pricing have more inflation than others. You know, here you see the inflation levels of poultry, you know, relatively modest to the likes of lumber, right? We have lumber hoarders happening, and so big prices spiking. Same with the likes of motor vehicle repairs we're seeing, and housing. These things have our pockets, and obviously our industry is tied to these areas, but it's not a broad spectrum of inflation that we're seeing. So our outlook right now is that we'll see relatively modest growth, and this aligns with the Federal Reserve as well. We think, and we're going to be putting out our new forecasts here in mid-August. So if you're a III member, you are able to get onto our members-only webinar and hear from our economists in all the different areas. But we still believe that it's going to be modest growth. We don't get up to the areas where the market view gets into the 8, 9, and 10% growth levels. Still some things hanging out there, though, that could impact that. One area in particular that we're seeing and is a cause for concern, and we're looking at closely, is cyber and what that could do. What if we have a pandemic-like cyber event? How does that fare, one, for our industry and the economy? So we're beginning to see just people being concerned about this. Housing prices, you know, are we in a housing bubble right now? So there are some threats out there, and we're still seeing the threat of COVID-19 potential. You know, this is happening right now. We're seeing with this Delta variant, masks getting back on. I live in Washington, D.C. You can't go into a restaurant anymore without wearing a mask as of last Saturday. So what does this all mean? Today they said we're at a 7-day high, average high in terms of COVID infections that was a high from last summer. So we're getting back into an interesting place as to what COVID's going to do to the economy too. So have to keep an eye on that as well in terms of recovery. So how did the industry perform, and do we think it will perform going forward? Overall, this industry, you know, slow and steady wins the race. So all of our economic indicators are relatively positive, but they're not big spiking positives, right? We rely primarily on the likes of fixed investment. In fact, that 18% that you're seeing there, which is our exposure to equities, was actually up a couple years ago in the 20-25% range. So we're going back to our safe fixed investments with all this market volatility. Seeing growth in our investments overall, again, not huge significant spikes, but good growth. The combined ratio looks like it's creeping back under 100, but you'll see we've actually had a nice 4-year stretch on our combined ratio. And the policyholder surplus hasn't always been a big economic indicator actually for us at III, but because it took a little dip during COVID, we started paying attention to it. It's back up to where we think it should be, about twice as much of a level before you start getting into some solvency issues. And then overall, we still see net premiums growing faster than the economy. This tends to be a normal thing, but we believe that will get back on track again. And net premium written growth, so last year we saw it actually outperformed what we thought during that level, but we're still a little bit below the 10-year historical average. We're going to see, we're right now looking at the policyholder dividends, which are neutral at this point. And then here's our combined ratio. And you're seeing, you know, most of the time, we have been looking at years, most of the time we've been getting over 100, but you're seeing two stretches right there and 2012 to 15 where we were below 100, and then we're back on that trend as well. Again, it's creeping up towards 100, but if you're looking at one thing in particular, when you have these 3-year stretches, these are historical. That first 3-year stretch that we saw starting in 2012 actually was the first time since the 70s that we saw that. So we're getting our underwriting in good place, if you will. Here's our policyholder surplus. I'm going to talk a little bit more about policyholder surplus when we go into the ESG topic, but again, a good illustration of how this industry, when you see areas where there was economic volatility, pure economic volatility, the financial crisis in 08, we dipped a little, went right back up. You see the COVID dip there, very temporary, got ourselves back up as well in terms of the policyholder surplus. It's a good story for us to tell. I mean, you always hear about, is this industry overcapitalized? But from our perspective at III, it's really nice to be able to point to a policyholder surplus when you've got 4 hurricanes in the Atlantic at the same time, and CNBC is trying to ask if the industry is going to face solvency pressure. So the other thing to understand is where our income and profitability is. Investments are the vast majority of where profitability is in the industry. In fact, assets under management in this industry are close to $7 trillion. That's as big as BlackRock. But you're also seeing in this picture that we're getting a focus as well on underwriting. So the green areas where underwriting is, you're seeing that we're beginning to grow our underwriting as we're facing some pressure. You're seeing the decline in investments because we've seen rates not be where they are, but so at the same time we're getting our underwriting back in check. And this is our yield on investments and assets. So again, as the rates have been what they were, it hasn't moved in the right direction. We do believe that we're going to get that direction back up to where we would like it to actually begin to grow again in terms of our assets. Because we're very reliant on fixed investments and monetary policy, we have been mostly impacted by the rates and where they've been. But we do see that the rates in the year or two, we're probably going to get back, begin at least trending more positive. And so by and large, what you're seeing here is the overall performance of our industry being positive. We were right around the 10-year average, but it was stronger, and it was also stronger than expected through COVID. So again, as an industry, we faced a lot of impacts. We kept the claims paying, but we still kept ourselves in a good place in terms of profitability and income. And then the last thing I'll talk about, which is always a good economic indicator, are mergers, M&A, mergers and acquisitions. Haven't seen quite as much on the carrier side, seeing them here and there, but this is actually a depiction of what's happening on the agency side, which I know my friend Steve and I were just talking about. One trend that we were seeing, except something happened with the antitrust suit that filed, is that it used to be the little guys were getting absorbed by the big guys, but now what we actually saw was a difference. Obviously, we're seeing big going after big. It'll be interesting now that we've seen the Justice Department file the antitrust suit and what happened with Aon and Willis as to whether or not that trend will actually continue. But everybody's looking for margin, everybody's looking for yield, and everybody's looking for scale. So especially on the agents and brokers side. So you're seeing a lot of activity there. So underwriting trends we'll get a little bit into, and this is where, again, we're forecasting now at the III with our new actuaries and new economists that we've brought in. We're able to actually begin forecasting. So if you're a member, you're able to get this information, one, in real time through our dashboard, but secondly, through quarterly updates. But I'll give you all, this is the last quarter that we did through lines of business. We'll be updating it again in mid-August. And I'll just go through some lines of business here. Commercial property was probably the most impacted by COVID. Stores closed, businesses, you've got a lot, everything had to go stagnant. But we do see it going back in the positive for commercial property. Commercial property rates have continued to increase. As a result of kind of where things are, obviously looking at like a hard market here. But the other two things that are outlying on this line of business, one, where the litigation goes with the likes of business insurance and where the costs are, and bankruptcies as well coming out. So depending on how long it takes for this area to recover and businesses to get back open, I think is going to be a real potential challenge for this line of business. Homeowners was probably one of the areas that we saw less impact during COVID than others. We all think that when people are at home, they're more dangerous. But we actually didn't see more claims. Not as many kitchen fires and all of that. But we did see active catastrophe seasons. And I think what we saw in Texas was a real interesting hit for the industry, and it'll be interesting as we get through the hurricane season this year. Nothing yet. Last year, I think we got lucky on hurricane season, and that didn't hit. It didn't hit very populated areas, but I'm going to show you some illustrations where it's inevitable that it will. So we've got to keep an eye on it for that reason. Other thing to consider about homeowners right now is we have seen those very high lumber costs happening. We got a labor shortage in construction, so there's some issues potentially challenging that in terms of people getting their claims back and getting back recovered, and the costs of all of that as well. So commercial auto has really been under significant strain for some time. You've got just the amount of costs that go along with what's going on the roads is significant. You got some relief because less personal auto were on the roads, but the commercial did try and stay intact and kept going. So there was some relief, though, with less people being on the roads through COVID, but we don't see that really lasting in any way. We do see there's going to continue to be significant strain in the commercial auto space for a couple years at least. And then personal relief, even though the industry gave back $14 billion, we still ended up in a relatively good place. And we do see that this industry will on personal auto will get itself back up. You had less accidents through COVID, so obviously you had less claims. One thing that we think is going to get interesting on personal auto are using telematics and even short-term driving. Those two things started getting a lot more interest from consumers through COVID than before. People began to get a little more comfortable with it. If I'm not driving as much, why should I be paying as much? Those types of things. It'd be interesting whether or not that trend will continue and whether or not it's something that sticks into the industry in the personal auto space. The other thing to consider, for a couple things to consider that are still happening in the personal auto space that makes it a bit of a challenging market is autos are just getting more expensive. They might be putting in more safety tools, but they're certainly more and more expensive year over year. The other thing about it that's happening as well is auto repairs are getting more and more expensive. It's not just about the bumper that, by the way, on a mid-sized luxury vehicle has gone up 3 times an amount in the last 5 years in terms of cost. You have to have somebody that knows how to calibrate the thing with all the cameras and everything else that's on it. So auto repairs will continue we see to be a challenge in the personal auto space. And then workers' compensation was a bit of an outlier for the commercial space, and the rates have been going down in workers' compensation. I think coming out of COVID, where the question mark happens in workers' compensation is maybe the long tail results of people working at home more, and whether or not that's going to have impact on claims in different ways. People in a workspace that's controlled, you are able to understand and make sure that the environment is safer. But people when they have their own choice, just want the cheaper chair over the expensive chair, and they're sitting on it longer. So, are there going to be some longer-term results from COVID-19 and workers' comp? I think something that we're going to keep an eye on. And cyber is something that has really been an interesting part of this issue and the liability side of it. So you're seeing how it became underwriting where the rates got a little low there, and now they're jumping right back up. And so what we've seen is a lot of people wanted to jump into the market because it was a new market, new space. We all knew we didn't have enough data. Now that we're getting more data, now that we're having more incidents, now that we're having like some ransomware, it's being something that we're critically underwriting more and making sure the exclusions are there and/or a separate cyber business policy, for example. The other side of the cyber issue, one, it's not just about a hack, if you will. This is a political risk that's happening. Most of these cyber incidents, it's not an IT issue as much as a diplomacy one. You've got states inside of states that are made from cyber in terms of their revenue and their economies, right? They're state-driven, sovereign-driven types of incidents. So we're actually beginning a project at III is what is cyber insurance and what is it not? Because again, there's a government issue going on, law enforcement and political diplomacy and all of these things that really the insurance industry can't control. So we don't want to get to where we were in the pandemic where people just think insurance is a solution for cyber. So we're right now informing this discussion and helping people understand those differences. And so one thing I will put out there, because we said that commercial rates were beginning to increase, we are seeing some plateau in those rates and the pricing. So we may be seeing where the commercial side of the business in terms of property casualty may be plateauing on rates, whereas it's been rising year over year. So just something to consider. And then I'll just give you a plug if you want to get all of this information for yourself, or if you want to interact with it. We've actually built a system at the III where you can go and interact and get lines of business and our forecasting and all those types of things. So great new economic tools that for you at the III, economics.iii.org if you're a member. ESG is a big issue as well for all of us, and this is something we think we can really lean in on in a good way. We've got a really good story to tell. So I know many of you with your regulators and others are saying, what are you doing for ESG? What are you doing around climate? Well, our industry has been looking at climate for a long time. You know, these are insurance loss costs since the 80s. They've increased 700%. And if you know that and most of your loss costs deal with natural catastrophes, you obviously know something's going on with the climate in some way, shape, or form. Steve, I think, will tell you too, it's some of the things that are going on with climate is not just the catastrophe cycle. So I know he's going to get into that. But again, we're prepared. We're paying close attention to this. This is why our policyholder surplus is increasing, because we know something's going on and we need to withstand it. We need to keep our promises as an industry. And this is why, you know, we say at III, ESG is in our industry's DNA. You know, we've been looking at environmental issues. We help underwrite, recover, all of those ways as we're experiencing these large amounts of changes that are happening. One, because of catastrophes. Two, because people are living more in harm's way. The governance side of, you cannot be more governed than the U.S. property casualty industry. So we have a very significant, so anybody questions, you get questions on governance, depending on where you are as an insurer, you know that you're spending a lot of time being governed. You've got the ORSA process. So sometimes when you get these buzz terms, people want to layer on new things, you know, that are ESG. And there are some disclosure issues that I think will probably happen, but where we're getting worried is whether or not we're going to layer on new regulation or different things just because, you know, ESG is something new that people are looking at. And on the social side, you heard me talk about all these organizations that you're supporting that bring social benefit. And you're also all those fixed investments that we have more on the income. Those are doing community building. So you've got a very good story to tell on ESG, and if you want more information on it, we're putting it out and together. You can go to our website. But this is something we shouldn't shy away from. We should really lean in as an industry. The Fed has been, you know, one thing we're trying to do is make sure the Fed doesn't want to regulate us, so we're explaining our industry. But as we're explaining our industry, they're getting excited and potentially using insurance as a model for other financial services and how they might want to look at ESG. So just a little bit more info on how we drive the ESG. Getting back, we help communities be more resilient. We help people manage their risk as change is happening. We give back significant amounts in terms of charity and community building. And then, all of these organizations, IIHS, IBHS, III, these are all industry-sponsored events meant to bring society good. So the last thing I'll touch on quickly is around resilience and the project that we have at the III, our Resilience Accelerator. One thing we're doing here is this is actually something you can go and interact with at resilience.iii.org. is we've tracked hurricanes visually back to the 50s, and we've now put on the economic impact of all of those. This is a track from 2000 to 2009. Now, this is the track going back to the 50s. Our point here is these things aren't going to miss communities, and people are moving more and more into harm's way with the likes of hurricanes. So we've got to figure out how to help people understand there needs to be behavioral changes that take place. Our customers need to think about risk a little bit more. It's really neat to want to live on a barrier island or in a beautiful forest in California. But as it stands, we don't fit risk into the everyday property purchasing process as much as we should. And we need to, because I think Steve will show you that populations are changing. And they're moving into, Texas's population has doubled in the last couple decades. And Texas has every natural catastrophe you could think of exposed on that state. So populations are shifting, people are moving more and more in harm's way. We've got to make sure that we create a movement so that people understand there's only so much we can do with price on risk. Right? We need to help people understand that this is something we need to manage the risk a little bit better and become more resilient. I've sat around a lot of resilience discussions for a long time, and everybody gets frustrated that the change doesn't happen. So we've created action partners that are dedicated to really driving change. We've set up a memorandum of agreement with FEMA. We work directly with the National Flood Insurance Program. Steve has done a great job at Aon, who you hear from, providing us data and information. So Colorado State University with the hurricane forecasting, and Wharton with their risk center. So we want to drive actionable change and make sure that communities understand how to be more resilient. And one way we do it is through interactive illustrations of risks that's out there. So these are some screenshots from the website I mentioned to you that you can go to. You can look at every county and interact with it on NFIP take-up rates. It's alarming. The lack of NFIP take-up rates, and as well, you can look at special hazard zones now. We've worked with the InsurTech paper crane that allows you to understand personal and commercial property in proximity to special hazard zones. The other last neat tool that we put up there that Hazard Hub helped us build is, again, you can go to Zillow and get your walkabout score, or you can get your school ratings, and those change behaviors. Trust me, my wife said, we're not living in a place that has an 8 or below school rating. Changed our behavior. What about putting this, and we're working right now to try and get this into a real estate app. This is you can type in any property in the United States, and you can get up to 30 variables of risk for it for free. Hazard Hub helped us build it. Hazard Hub, actually, you can get up to 300 variables of risk if you work with them. But we're just trying to bring more understanding of risk when it comes to people, again, wanting to move into these beautiful areas. They need to understand what the risk is, because insurance can only go so far as the solution. So with that, I'll leave you. I think disruption will always be part of what we do in insurance, but I think we really, as an industry, step up in so many ways. And part of what I try and do with III in this job is not just empowering the consumer, but empowering you to feel good about what this industry does. And I think we proved ourselves through COVID-19 that we can step up in terms of giving back to the community, step up in terms of keeping claims, step up in terms of making sure that we stayed economically fit through it as well. And we have more to do. We have more work to do. We have more education to bring to the consumer. But overall, we're going to do that. And again, we are most well poised as an industry to lead through this disruption. So hopefully you feel better about that, and hopefully we'll have more good stuff to talk about if I get to visit you again. So thank you very much for your time.